Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we're focusing on how politics can affect stock markets, from Brexit and emerging markets to Donald Trump's trade policies. Let's start with Brexit. Our first guest, Michael Metcalfe, head of global macro strategy at State Street, likens a no-deal or hard Brexit to a natural disaster that will inflict serious damage on the UK economy.
Hi, Michael.
Hello.
So what's caused this unexpected spike in inflation for August to 2.7%?
Well, firstly, it was a surprise. I think we were expecting this gentle decline in inflation, and I think there are a couple of things influencing that. I think the first, obviously, is activity. We've had a spike in activity, and again, we're not sure whether that will last, but we've certainly had a spike in activity over the summer, and then also we've had a combination of sterling weakness also. So I think there's a conglomeration of factors that have created this, but it's going to be really important now to see whether it's just a one-off or whether actually the downtrend in inflation has paused.
And if this is not a one-off, if we continue to see sort of this level of inflation, surely that has an impact on interest rate decisions.
Absolutely. So, so far the Bank of England's been very relaxed and very gradual in their tightening cycle. It is a tightening cycle. Rates are expected to continue to go up, but they've been allowed to be gradual. And I think the risk is that with the labour market as tight as it is, rising inflation from the current level means they might have to go a little bit faster, and that could be problematic for markets. Now,
inflation is higher than we'd like it to be, and as you mentioned there, the employment market looks good. We've got low unemployment. Those are typically signs of an economy doing well, but there are some concerns about the UK economy, aren't there, because of the spectre in the room, Brexit.
I thought we'd get to Brexit at some point. Well, it's interesting on growth, isn't it? Because we're growing at capacity, or we have been growing actually even a little bit more than the capacity. That's what the labour market is telling us. But growth has been a little disappointing. It wasn't quite as bad. Following the Brexit vote, everyone thought there might be an instant recession because of a shock to animal spirits, and actually in the end, animal spirits held up very well. Confidence was fine. It's very different now, though, because actually right now we're trying to make investment decisions. Companies are trying to figure out what they do in 2019. And unfortunately, because of Brexit, we still don't know. And so I think uncertainty, at least on the investment side, has been a big drag and will continue to be so until we figure out the shape of Brexit.
And how do corporations and indeed consumers invest in a market where there is such uncertainty?
Well, I think from the consumer point of view, for the moment, and we've mentioned it a couple of times already, the key is the labour market. And so, I think until Brexit uncertainty begins to affect employment prospects seriously, then actually the consumer side at least has held up quite well. And that's sort of been borne out a little bit by the recent data, albeit, we know it's distorted by fun things like the World Cup. On the investment side, that's a lot harder from the corporation side. And here we're talking really about business confidence. There's been a lot of open public debate about how difficult it's been to make investment decisions. And so that's where the hesitation is. And that's really where the shape of Brexit is going to matter an awful lot.
And Brexit is a very emotive issue. There have been some quite negative headlines. Journalists, I'm sure, have ourselves played into that, but so have politicians, so have business leaders. How concerned should an investor in UK stocks be about the UK?
Well, so it would be very easy to look at how markets reacted around the original referendum result and say, well, actually, we were overly concerned, and actually the economy did fine. I think the reality of an actual Brexit when it comes, particularly if it's a hard Brexit, will be very different from that, because a hard Brexit would be an immediate real economic shock. And look, and as you say, it's very difficult to predict precisely how big an economic disruption it will be, but anything that physically disrupts trade and supply chains, which is what we're talking about, is akin to a natural disaster and the impact on an economy. So, I think that there should be concern. There's certainly a real economic risk of activity being significantly disrupted, and that's over and above the impact on investment spending and animal spirits. This is a real economic disruption that we're talking about here, and it's difficult to see, given how late we are on the game, as if we have a no-deal Brexit, it's very difficult to see how you'd escape some physical, actual economic disruption. So I think to that extent, yes, there is going to be some concern. What's the probability of a hard Brexit versus a softer Brexit and getting a deal? I think that's the thing right now that the market is weighing up, and it's swinging around with all the different commentary. I would say right now, the very latest commentary, which is dated at the bottom of the video, seems to be actually that we might get a deal, and that's the track that we're on. But there's still a risk that we get knocked off, maybe by UK politics more than anything else, onto a different track. So yes, it's something that investors really need to consider because it's a real economic shock.
Michael, thank you very much.
Donald Trump's tax reforms will cause inflation, and this will cause interest rates to rise. But dwindling liquidity is a concern too, says Jeff Boswell, manager of the Investec Global Total Return Credit Fund.
Hi, Jeff.
Hi, morning, Emma.
So I thought we'd start with a cheeky question. Predictions for the rest of the year. What can we expect from central banks? Let's start maybe here in the UK. Will the Bank of England put up rates again?
Yeah, look, my crystal ball, unfortunately, is a little bit hazy, but I think from a UK perspective, I think you've got to look at the factors that they're facing, and I think Brexit, unfortunately, hangs over them, and such that even if I think we start to see a bit of a pickup in growth and we see a bit of a pickup in inflation, they're gonna be apprehensive in terms of going too quickly. I think, and this is a dilemma facing any central bank, I think to the extent inflation really starts to kick up, then they're going to feel they need to move. But I think if you look at actually what's priced into the market, certainly from a UK perspective, I think the broader market is saying there's only a 30% of chance of another hike by the time we get to actual Brexit next year.
And what about the US then? Perhaps a little more clear there.
Absolutely. I mean, the US, even though we had a weaker inflation print yesterday, the US is rollicking along, certainly from a growth perspective. And we've seen that coming through in terms of corporate earnings as well. So the risk in the US is that there's really a surprise to the upside from an inflation perspective, and then they feel they're slightly behind the curve. From a credit investor standpoint, this kind of looks like a normal cycle whereby, the Fed will tighten until they go one tightening too far, and then obviously the markets react quite violently to that. But the Fed, I think, they're going to be driven more by data, and it's going to be how's growth actually developing, and do they have any inflation surprises?
Now, how much do markets get impacted by rate hikes, given that we do seem to have quite a lot of insight into what central banks do? I mean, ever since the taper tantrum, central banks like to really signal their plans now. And so for bond investors, and indeed, all asset investors, because everything's connected, does a rate hike really make that much of a difference anymore?
I think the central banks are doing whatever they can to signpost it in terms of trying to make sure there is no surprise. And, the ECB with Draghi is the best example of that. I think where markets will react adversely is to the extent, to exactly as we were just talking about, there is a surprise, an inflation surprise to the upside, and they have to move quicker. Because as an investor, certainly as a credit investor, it means we're a step closer towards the end of the cycle. And I think that's what you're always worried about. So it's, there's an element of picking up pennies, because that if the Fed keeps going, eventually it gets to a point where financial conditions are tightened to such an extent that it has a real impact on the economy. And that's really what you're grappling with as an investor. So I think to the extent that we stay on the course and they keep signposting things and there's no surprises from a growth perspective, the markets could carry on trundling on. But there is obviously a risk to the downside as well.
It must mean that you are obviously data crunching as well as an investor, not just leaving that to the central banks. You've mentioned inflation as one kind of signpost that may be a red flag. Are there any other particular figures, jobs figures, for example, that you as a credit investor are watching to get some insight into what happens next?
Absolutely. Well, certainly, I mean, across the macro spectrum, we've got a team of people that are continually crunching numbers. The interesting thing is, I think inflation is in our mind what's front and foremost in terms of most central banks' minds. And I think certainly from a US perspective, if you look at that, we've had the biggest fiscal stimulus package in terms of the tax cuts at full employment in history. And that undoubtedly has had a knock-on in terms of economic activity and corporate profits and the like. And so, naturally the knock-on to that is with full employment and with that fiscal stimulus, there's going to be a knock-on to inflation. And that's really, I think, why a lot of people talk about inflation. We look at a variety of other metrics. I think from a credit investor perspective, the one thing that we're all worried about is in this world where we're moving from QE to QT, We talk about rate rises being a part of that, but part of it is obviously asset purchase programs and the like as well. In this world of moving from QE to QT, there is just liquidity being withdrawn from the market. And that in itself is having an impact on financial markets, and certainly the weaker elements of the market. We've already started to see some cracks.
Jeff, thank you very much.
Thank you very much for your time.
Continuing with President Trump, Somerset Capital's Edward Lamb says you can't ignore political risk when investing in emerging markets, and so is favouring India and investing away from Trump's tariffs.
Hello, Ed.
Good morning.
This has not been a great year for emerging markets. I suppose the big question is, are the fundamentals still strong? And has this been sort of overplayed? Or are there genuine reasons to be concerned when investing in emerging markets at the moment?
Yeah, I think obviously it's been very difficult. I think long-term, all of the key drivers that we should be optimistic about emerging markets are in place. Valuations are even lower than they were and after the correction. More importantly, we still see a lot of strength in the underlying companies. So earnings locally actually are quite strong. And then I think the big thing that has held back or impacted emerging markets is actually, frankly, Trump foreign policy, which has had a much bigger impact than we certainly expected. And if you look around, just taking one specific example, but if you take a market like Russia and you look at the banking system there, things actually look really good. Non-performing loan levels are coming down. Lending is actually accelerating, but there's just a massive political overhang, which means that these sorts of stocks are trading at valuations half of what really we think they should be.
And you can't ignore things like that, can you? I mean, you as a stock analyst, you can look at a fund's balance sheet and say it's going a stock's balance sheet rather, and say things are going well, the dividend may be covered, but even if the fundamentals are all strong, Trump making ever more volatile decisions does have an impact on share prices. So how does that influence the way that you run a fund?
It has a massive impact. We try to deal with that in portfolio construction. So we try to diversify risk, not having too much in politically sensitive countries. One of the things that, one of the places we're adding to now is India, and that's partly because we think there is less overall political risk. If we look at what Trump has been talking about and where he's very focused on China. He's quite focused on Mexico and NAFTA, but certainly he seems to not really be interested in India, which is great. So that's certainly an area we're adding to.
And how does a dividend strategy influence those decisions? Presumably, if people are choosing to reinvest those dividends, it does smooth some of the volatility that can be associated with emerging markets and has been this year. As a stock selector, do you see certain characteristics in dividend stocks which makes them more protected from some of this volatility?
It should do. I think in the long run it does. In the short term, we haven't really seen that protection. I think partly because it's been so uncertain as to where particularly Trump is going to hit next. I mean, we've seen two bankruptcies of companies that have essentially been politically driven. So that's, or risk of bankruptcy. So Rusal in Russia and then ZTE in China, both politically motivated and attacks on a particular company. And so I think what investors are concerned about is even where you see good, strong companies with reliable cash flow streams, there is an overall much higher level of uncertainty.
And you've mentioned country-specific concerns or opportunities even. Are there any sectors that you are wary of at the moment because of this kind of political overlay?
Yes, so it's actually less sector specific and more country specific. So we're actually quite comfortable being invested in more global sectors, so oil and gas and things like that are less. I think there's less that Trump specifically can do to target whole sectors, but he's been quite specific with regard to countries, whether it's North Korea or Turkey or Russia and areas like that.
Ed, thank you very much.
Thank you.
Our next guest is Olufemi Mada, Senior Investment Analyst from Morningstar Investment Management, who talks to us about why it has been a difficult 2018 for emerging market bonds. Specifically, he discusses how Turkey and Argentina are only a small proportion of the bond market, but their current problems have impacted returns across the asset class.
Hi, Femi.
Hi, Emma.
So it's been quite an eventful year for emerging markets. I thought before we look forward, we could perhaps recap over the last year. What has happened to emerging markets in 2018?
It's definitely been a very tough time for emerging markets. But before I think I would like to stress that there are two ways that investors typically get exposure to emerging markets. So there is the local currency side, which is bonds that are issued by governments within their own currencies, and then there is the hard currency debt, which is bonds that are issued by emerging markets, but then in foreign currencies. But whichever way you choose to look at it, it's definitely been a very tough year for emerging markets. So the local currency bonds have been down by 10% year to date, and the hard currency bonds have been down by 5% year to date. Which compares with the global aggregate bonds, which is down by 1% year to date. And
what have been the drivers of those falls? Why have emerging market bonds done so badly this year?
So there are three main factors you can think of. The first one is the dollar story. So the dollar has actually rallied by 4%. So in that environment, typically emerging markets tend to underperform. And then, compared with emerging market local currency basket, the dollar has actually been a bit rallied by 10%. So that's definitely been one driver. The second driver, you can also think about the current environment. It hasn't actually been favorable to trade. So investors are actually worried about the ramifications of the constant trade threats that you're getting from the US. The third factor is commodity rallies. So when you look at where oil prices are year to date, or compare with this time last year, oil has actually rallied by close to 50%. So when you combine these three main factors, it's actually exposed some vulnerabilities within some countries in the emerging market bond index. So countries like Turkey, Argentina, South Africa, and things like that.
It doesn't sound like a very positive position for emerging market bonds to be in. As you say, you've got strong dollar, you've got worries about the trade war, and you've also got the rising commodity prices. Do you think that these are enough reasons to be negative on the asset class? Or do you think there's a bit of kind of fear is overdone and they have slumped too much? Like, what position are we in now going forward?
So when you take the basket as a whole, so the typical basket that investors look at when they're thinking about emerging markets is the EMBI Global Diversified Bond Index. So when you look at that basket, there are a few countries there that are clearly, they're having issues. So the countries I mentioned just now, so Turkey, Argentina, and things like that. But it's much more than these countries. And those countries that I mentioned are actually a very small part of this index. So Turkey is only just about 3% of the Global Diversified Bond Index. And Argentina is actually even less than 1%. So even though Argentina has actually done minus 50% in USD terms year to date, it's actually the impact on the total index is relatively muted. So that's the first thing I would highlight. But the second thing is we have to think about the longer term fundamentals. So if you go back to 2013, where emerging markets are as of today, most of the countries within that index have actually improved their current account deficits. So except for these few countries like Turkey and Brazil and things like that. That's the first thing.
So fundamentals are strong?
So the fundamentals are strong. It doesn't actually, quite a few of the countries are improving their fundamentals, and the growth story is actually still there, which allows the countries to actually deleverage and improve their fiscal position over time. So we think that fundamentals are strong and they're getting better. So if you go back to where emerging markets are like 10 years ago, a lot of the countries are now comfortable to issue bonds in their own currencies, and the proportion of their total bond issuance within their local currency is actually getting bigger and bigger. So the fundamentals are strong, but there is the shorter-term impact of the headline news, and that's actually impacted. That's driven volatility year to date.
Femi, thank you very much.
Thanks a lot, Emma.
Turkey and Argentina may be in trouble, but the contagion slump has gone too far, says our next guest, Delphine Origi, manager of the Old Mutual Emerging Market Debt Fund.
Hi, Delphine.
Good morning.
So emerging markets have been in the news a lot recently, and not always for the right reasons, especially emerging market debt, which is an area which is influenced by currencies. I thought perhaps we'd take them one by one, Turkey and Argentina, because they're drawing the most headlines. What are your thoughts and concerns around the Turkish currency?
Well, Turkey has indeed been under a lot of pressure, deserved in our view. The central bank there has been reluctantly hiking rates. They've always been responding to inflationary pressures and to some extent market pressures a little bit too late and too little in the magnitude of the rate hikes that they've been delivering. Obviously, they're running a very large current account deficit. The fiscal loosening that we've seen in the last couple of years have also fueled some of that current account deficit. And really, their inability to deliver those hikes have sort of put the pressure on the currency. We think the latest development, and in particular the rise in the inflation print, is finally pushing the central bank to address again those issues. And we have hopes that at the next meeting in September, they will finally deliver a hike that is enough to meet market expectations.
Now, jumping across the globe, before we bring the two together, what are your thoughts on Argentina?
Well, Argentina is probably a trickier case. Again, they've also had a large current account deficit, but obviously they've been struggling with a lot of imbalances inherited from the previous administration. The government has been trying to juggle restoring growth, capital spending, and at the same time reining in the fiscal deficit. This has all gone a bit beyond their expectations. They lost the battle against inflation, and they've seen a lot of capital outflows resulting from that, not only from the offshore investors community, but also from the locals who also have lost confidence in the economic outlook. We think the measures that the government has announced lately and fast-tracking the fiscal consolidation are all the right measures and all going in the right direction. Obviously, the guarantee from the IMF program is also should help restore confidence. It hasn't been the case yet. The market is still sort of hesitating as to whether Argentina will make it next year. And we think the market fears are a bit overdone at those levels. We think we will continue to see some pressure on the currency in the very near term as the central bank continues to unwind that stock of leibachs, as we call it, the short-term treasury bills that they've been issuing against the sterilization of portfolio inflows in the past. So as long as they continue to unwind that stock of leibachs, some of it is not being rolled over into new debt. And that releases liquidity in the system, which in turn find its way to the dollar market. So we might continue to see a bit more pressure in the very near term. But eventually, given the extent or the magnitude of the correction in the currency that has lost more than 100% year to date, policy rate now at 60%, we will see a very strong adjustment in the current account, probably to a balance account next year. So that will reduce some of the pressure. And at the same time, I think we are coming to a level where even the locals will start to see less of a need to push for further dollarization here.
Now, of course, as an active fund manager across emerging markets, you don't have to invest in those markets if you see the risks as too high. Mm-hmm. But the logical question is, how much contagion risk is there among these Eastern Europe and Latin American countries? Because you get to a point where these things can't be contained and it does start to affect the asset class as a whole. Mm-hmm.
Well, we think that the contagion that we've seen lately is a bit overdone. Again, a lot of that is also linked to the external environment that has become a lot more challenging for EM. We've had a rise in the Fed rate hike expectations, the unwinding of QE that is all adding to a tightening of global liquidity conditions. And on top of that, we have a lot of uncertainty when it comes to an escalation of a potential trade war between the US and China, and a lot of negative news in terms of geopolitical pressure coming from the US onto those very different countries, Russia, Turkey, you name it. So we think the environment really has precipitated that contagion. But we think at this stage it is a bit overdone when it reaches countries like Indonesia, and the rupiah that is now trading at weaker levels than back at the 97 Asian crisis. Indonesia is in a much better place nowadays. They do have a current account deficit, but it's a relatively small one, even compared to the levels during the taper tantrum crisis. And the central bank has been very proactive in trying to insulate the market from global turmoil. So we welcome all those preemptive rate hikes that they've been delivering, initiatives from the government to try to rein in the current account deficits by reining in capital imports. And we think ultimately that will be recognized by the market.
Delphine, thank you very much.
Thank you.
Is rising volatility the start of the Great Correction? Our next guest, T. Rowe Price's Chris Alderson, explains why stock market performance is diverging and what investors should expect next.
Hi, Chris.
Emma, hi.
So first things first, congratulations on winning the Morningstar Analysis Award for Outstanding House. I thought today we could talk about the broad global outlook, because you do have international equities and you are an international asset manager.
We are.
Over the last year, markets have seemed to diverged in their performance. The 12 months prior to that, everything moved up together. What have been the drivers of that divergence?
Well, firstly, we're absolutely delighted with the award, so thank you. And it's fantastic for T. Rowe Price. Why have markets diverged? Why were they working in tandem before? I'd say, we had very low rates. We had quantitative easing around the world. The central banks are taking away the punch bowl. The dollar's gone stronger. We've got some economic divergence. The US is doing very well. Strong dollars obviously put pressure on different parts of emerging markets. We've seen the crises in Turkey, Argentina, that sort of thing. And then Mr. Trump never allows us to have a quiet day, does he? So, all the protectionist rhetoric is obviously in very full flow.
And where do we go from here? Obviously, volatility has picked up, although some are saying it's just returning to sort of more normal levels. Should we expect to see markets broadly moving up, but more volatile, or do you think this is the beginning of the Great Correction?
Well, I hope it's not the latter. I think it's probably not the latter yet. I think there has been more volatility, and I think more volatility is good. We welcome more volatility. For the last several years, the whole active management industry has been under pressure of everyone wants to go passive because everything moves together. I think it's good that we've got some dispersion. And I think we talked about emerging markets earlier. I think it's logical what's done well and what's done less well. Things like Turkey, we've been sort of predicting this slow motion train wreck for about 6 months now, and it's surprising that it took quite so long to come through. Will it lead to a real rollover here? I doubt it. Inflation's still low, rates are still low in an absolute sense. Economic growth is still pretty good. And I think quite a lot of the rhetoric is around the midterm elections. I mean, Trump clearly wants to get re-elected. The House is somewhat open for debate. The Senate looks more likely. And I think the rhetoric carries on until before that. And then possibly, boom, we get some fantastic deal. Him and Xi Jinping shake hands. Haven't I done a great thing for the world? And markets carry on.
And one thing I think that's quite interesting about this year is how much politics and geopolitics have influenced markets.
Yes.
Quite often you hear people say, well, economics and politics is not markets. And that's perhaps true somewhere like the UK. But increasingly over the last year, what's happened geopolitically has impacted stock markets, hasn't it?
It certainly has. And, I liked your earlier comment because that was sort of a refrain I was coming out with in the past, that actually all this geopolitics really didn't matter because it was all about money and effectively free money. It was all about free money, good economies and good earnings growth. And now money is less free. It's still cheap, but less free. I think that's leading to a lot more volatility. But also, the noise we're getting out of the White House is probably more extreme than we've had in the last 5 years or so. So I think it's perfectly understandable that it's created volatility.
Chris, thank you very much.
You're very welcome. Thank you, Emma.
There are 5 megatrends shaping the future of investing, according to our next guest, Rob Powell, thematic investment strategist at iShares. Let's dive straight in to find out what they are and how these megatrends are shaping global economies and stock markets.
Hi, Rob.
Hi there.
So BlackRock have identified 5 megatrends which are going to shape the way we live, the global economy, and even the stock market in the future. What are these 5 megatrends?
So megatrends are structural trends, so drivers of change in the world that are going to be playing out for the next 30 years or so. And we've highlighted 5 key megatrends that we think are going to be driving that change. So they are technological breakthrough. So that's all about the increasing speed with which technology is going to develop going forwards. Urbanization, so this is about the mass migration of people from living in rural areas to living in urban areas. Climate change and resource scarcity, I think we can all, with the summer that we've had, we can all, that resonates with all of us. Changing economic power. So this is about the increasing importance of the East versus the West, so the declining importance of the US and Europe, and the increasing importance of China as an investment location, but also as their share of global economic growth. And then finally, demographics and social change. So this is all about changes in population dynamics. So aging populations, the rise of millennials, things like that.
So it seems like each of those themes has both negative implications, but also positive ones. There are opportunities, investment opportunities in there. Perhaps we could start, though, with the negative implications. Technological change, for example. We have begun to see disruption and digitalization do away with traditional sectors, but presumably there are victims to each of these trends in terms of the way that we invest and the businesses that are out there today.
So I guess there will definitely be winners and losers for these kind of large-scale changes. If something like technology is both an enabler and something that does affect people's livelihoods and jobs, we would prefer to focus on the positive aspects of that and look at the potential job creation and value creation in investment portfolios that historically these kind of things have led to.
Now, I know there are some thematic ETFs where people can get direct access to these themes, but presumably also these are kind of philosophies and trends that everybody can access, in terms of there must be active fund managers at BlackRock who are really taking a look at these trends and the way that they're influencing themselves, as well as the sort of more specific ETFs that iShares are offering.
Yeah, absolutely. So, I mean, mega trends and thematic investing isn't something new. This is something that has always existed. Active portfolio managers have always focused on super long-term themes to drive their short-term stock selection. What is new is the advent of ETFs that can give you exposure to a very specific theme. And the reason that they do exist now is because of advances in data. So almost linked to that technological change megatrend that we have, we're seeing that play out in our own industry with improvements in data, enabling us to construct things like indices which can give investors access to things like robotics or digitalization, which are really about tapping into the effects of these long-term megatrends.
And also, just finally, there is also a rise in interest in ESG themes, which do sort of overlap slightly with these megatrends, don't they?
Yeah, absolutely. Particularly on the climate change side, we do have, there is that green element within here. So things like clean energy companies. And as you highlighted before, there are going to be losers and there are going to be winners. But if we can focus on the winners, so the clean energy companies that are going to potentially benefit at the expense of the incumbent fossil fuel producers, then we can have a positive impact on investors' portfolios.
Rob, thank you very much.
Thank you.
Looking for good value equities in the tech space? Ignore the FANG stocks and consider these 3 lesser-known companies, says Killick & Co.'s Rachel Winter.
Hi, Rachel. Morning, Emma. So what's the first stock you'd like to highlight today?
The first one is a company called Teradyne. So this is an American company, and it's involved with cobots, or collaborative robots. So we think that's probably one of the big buzzwords of the year. So I think it's quite widely acknowledged we're on the cusp of the fourth industrial revolution. So the first one probably back in the 18th century, when hand manufacturing techniques were replaced by steam machines. Then we had electricity coming along. Then we had the digital revolution, so computing and the internet. And the next one is thought to involve automation, artificial intelligence, and more computing and robotics. So that's why we started looking at robotics. Now, Teradyne is actually a business that's been involved in testing semiconductors. And at the moment, that's still the major part of the business. And it's still very important as we start to use more complex chips in our laptops and our phones. But why we like it now is in 2015, they bought a business called Universal Robots. And that's heavily involved in cobots. At the moment, it has over a 50% market share in the cobot space. Last year, the revenue from that division was up 70%, and they think they can achieve over 50% growth per year up out to 2021. So huge growth potential here. And we think this cobot division will become increasingly important for Teradyne.
Now, each of these revolutions, there were winners, big winners that then went on to dominate the market for, well, nearly centuries after the Industrial Revolution. But there were also losers, particularly thinking of the dot-com bubble bursting. How do you identify a company that's going to thrive in this new AI environment and one that is just an upstart startup?
Well, I think having over a 50% market share at the moment, and I think having such impressive sales growth, does give you an indicator that this is hopefully one of the successful ones. And back to your earlier point, I think having a lot of losers from each industrial revolution, I think it's quite important to look at that. And what's quite nice about Teradyne is they're focusing on cobots, so humans working alongside robots. So you're not necessarily getting rid of loads of jobs, you're actually just getting robots to help with the more difficult, the more time-consuming, or the more repetitive tasks, and you have still got a lot of humans employed. So that's one other reason why we like it.
And what's the second stock today?
Second one is IBM, so one of the biggest technology companies in the world. And this is one that we think is a little bit misunderstood. So it's very much seen as an old school hardware manufacturing business, and it trades on a price to earnings multiple of 10 times. And that's incredibly low.
Very cheap compared to other tech stocks.
Yeah, and the market in general trades at probably about 16 times. And then some of the bigger tech companies are on 20 or 30 times. So being on 10 times, very low indeed. And that's the sort of multiple you'd expect from a low growth standard hardware manufacturing company. That's not IBM. Over the last few years, they've been selling off their hardware businesses. They've invested in what they call strategic imperatives. And that's things like analytics, cybersecurity, cloud computing, artificial intelligence. And now the revenue from that part of the business is worth more than 50% of their overall revenue. So in our view, IBM is no longer just a hardware manufacturer, and we very much think it's undervalued.
What's the third and final stock?
Third one is Match Group, which I think is quite an interesting one. So this is involved in online dating, which is very much a high growth area. Now, Match owns about 45 different dating brands, so really a huge number. And that includes the most well-known ones like Match.com and particularly Tinder. So we think this is a space that is growing very quickly, particularly as it becomes more widely accepted and people become more comfortable with it. So starting with Tinder, that's done very well from the so-called freemium model, where the standard version is free to download and then they can charge users for extra features. And Tinder's got more than 50 million daily active users. It's an incredibly popular app. And then another high growth area for Match is actually the over 50s dating market. So this is a market where people are perhaps more willing and more able to pay. So where there might be less users in this particular segment, they do tend to pay a lot more. So that has been quite profitable for Match over the last couple of years.
Now, there have been some quite high profile companies who've been hit by data breaches. I imagine Match is one of those ones that would have to take that incredibly seriously, given the nature of their business. Is that something that you consider when analysing a stock?
It definitely is. So any technology company, any company involved in handling people's data, particularly sensitive data such as people's dating profiles, I think it's very important to look at that. And I think Match is very heavily involved in looking at their own cybersecurity.
Rachel, thank you very much.
You're welcome.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.